Both the S&P 500 and the Dow Jones have rallied to new all-time highs this morning on Thursday, with the Dow Jones rallying more than 800 points in market open, and the S&P 500 now up to 75.81. Meanwhile, the NASDAQ is down almost 30 basis points, and so there seems to be a rotation out of tech stocks into other sectors. We're going to be talking about which sectors are most likely going to benefit and what we should be doing in a broad rally such as this. Chris Vermeulen joins us once more. He's the Chief Market Strategist at thetechnicaltraders.com. This video is brought to you by Kalshi. It's the largest prediction market in the United States. Unlike a sports book, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here to get started and use my link LIN, L-I-N. Traders who use my code LIN will get $10 when you trade $10. Right now, traders are placing a 30% chance that the S&P 500 will trade below 6,300 points by this year. And we're going to be talking about this trade with Chris. If you place $50 on this particular trade, it may yield $144 if it turns out to be correct. So stay tuned. Let's see what Chris has to say about the downside and upside potential for the S&P this year. Chris, welcome back to the show. Good to see you.
Yeah, good to have me, Dave. Thanks for having me, David. Appreciate it.
Appreciate you coming back. There seems to be a bit of a rotation at work this morning as the NASDAQ tumbles. Investors rotate out of chip stocks for banks. And this is interesting because I stated in the introduction, the S&P is up, the Dow Jones is up, the NASDAQ is down about 30 basis points as we speak this morning. Now, people have been talking about this great rotation out of tech stocks into something else. I know you've been long since the beginning of April. Are you looking into rotating out of tech stocks yourself?
We've been scaling out. So as we hit some targets last week in the NASDAQ, right near the high, actually, we hit a target there. So we started to liquidate some of our position. We're not looking to get out of it right now. We're continuing to ride the train higher. There's definitely some signs of weakness just starting to kind of creep into the market. We've seen Broadcom, some news hit things today as you and I are speaking. And so overall, you got to stick with the trend. It is up, but we are seeing some of the underlying technicals just starting to break down a little bit. For example, we saw the market pull back. The previous session, we saw utilities, we saw real estate have a nice, strong early morning pop. And I've been following that very closely, and we're starting to see signs that big money in the markets is actually starting to look for little pockets of safety, and they're lightening their load. So overall, you got to be long equities here. I mean, who knows how far this train is going to run in tech, and you got to make sure you're on side with that.
Isn't a sell-off in tech going to lead everything down eventually? If let's say the entire sector is propped up by a few tech stocks, and this morning, for example, I'm reading CNBC right now, Broadcom sold off, and that led investors to pair exposure to stocks tied to artificial intelligence, says the article. So if that happens, wouldn't you expect a broad sell-off and everything else?
Yeah, I do. I do expect we'll see eventually tech have a very sharp correction. I mean, like today, you and I are speaking, the tech sector was down like almost 2.5% this morning at one point, even more than that. Yet the stock market is holding up. We're seeing the Dow, we're seeing small caps, micro caps all muscle their way higher. So there is money moving out of tech, but it is piling into the rest of the broad market. And I do think we need to be aware. I mean, I think it doesn't take much. One little piece of bad news and the tech sector got hit today very hard. And I think we just need a series of those and the markets could break down very sharply. So people just need to be aware of what has been very frothy, very quick and easy money in the tech space. Keep in mind, it can be wiped out very quickly with a series of sell-off days because it's more so a momentum type of trade, right? There's a lot of momentum traders in here, and they jump ship and abandon ship right away as soon as it starts to roll over, and that's what creates very sharp, quick declines.
And when you say you've been long, which index in particular have you been long on?
We've been long the S&P 500 and the NASDAQ.
Mm-hmm. Okay,
so
can you pull up
and the QQQ?
All right, great. Let's pull up a chart of either one. Maybe let's start with whatever you've got on the screen first. Yeah, that's fine.
Yeah, so if we take a look at the S&P 500, we've got on the right-hand side is the daily chart. And of course, we got long right over here. In fact, the best way to view it is kind of through the lens that I look at it. So there's two ways that I like to look at the stock market. The one on the left is price action. That's the daily chart of the SPY. It tells us when the trend and the money flows are positive, when they're negative. So when to own stocks and when not to own stocks. We got long here on April 9th. On the right hand side is kind of our lens. It's like almost like looking with like an X-ray machine into the market to see what the strength is or what the problem is. And we can see these color-coded charts is telling us the sentiment, the momentum, the money flow of what's going on. And so as things start to get very weak, it says, hey, this market is not strong. You should get out, which is why we end up getting a exit signal to move out of the stock market before it sells off. And it also tells us when a bounce turns into a rally, saying, hey, this is the market is healed. More or less, you're ready to go. There's a lot of money flow and momentum behind it that should support a trend. So, I mean, this is where we're at. We're just riding this market higher. It's a series of rallies and pauses. I do feel like it's been very quick, easy money. So I'm worried this market could run out of steam at any point. But the SPY, the overall market is just having a very controlled pullback. And actually, if we go back and look at this 30-minute chart, you and I have touched on this many times before. This is my panic selling indicator. And so yesterday we saw some panic selling and the stock market had a bit of a pullback. And I was telling subscribers this morning, yesterday's panic selling is usually going to be a little pullback, and we're probably going to see bargain hunters step in today. We'll probably see the market gap lower, and then bargain hunters step in and buy price up. And when we zoom in, we can see the market gap lower this morning. People panicked. Those who didn't get out yesterday got out at the open, which is why it opens lower. And then boom, we've got this strong, gap being filled and is rallying higher. So the markets are moving exactly how they typically move in this type of market environment with overbought, oversold conditions. And yeah, you just got to really let the markets do their thing, right? It's not about predicting price. It's just follow what the money flows are doing, follow the price trend charts and manage positions.
This is the key here. It's not about predicting where the markets are going. Most people can't do that. Even the best traders don't do that. What they do instead is proper risk management to protect the downside. How do you do that?
Yeah, so we do that through a series of ways. I mean, we can look at this is the Nasdaq trade, but very similar as the S&P 500. The way you do that is to have rules in place, have a strategy, right? So when price starts to move up, you move your stops up, you slowly scale out as you hit certain thresholds, knowing the market eventually will have some type of reset and calibration that you could get back in again. Overall, you need a rules that when the market starts to pull back, you have to be able to identify, is this just a normal pullback within the uptrend? Or is there something underneath the hood of this market that is showing real signs of weakness? Is it actually starting to break down? And so that's kind of how we look at the market, through this lens over here. When we see deep red, that means the market is breaking down, it's weakening, it's bleeding liquidity, it's bleeding shares to the downside. And so we want to step aside. And so it really comes into just being, decisive and having rules and discipline to say, okay, the market's strong, we got to get back in. As we know, the market climbs a wall of worry, and who knows, it can go as high as it wants and keep going that direction. And so the same when it reverses. When it reverses, we've got these big profits and these big gains, but you do at some point have to get out and protect your capital because you don't know if it's going to be a 3 or 5% correction or potentially like a 30 or 40% correction that takes years to recover. And so that's what we focus on is making sure that when the market rolls over, are we reanalyzing and saying, is this just a pullback or is this the start of something uglier and we should protect our capital?
When we're trading in a bull market such as now, how do you place stops? Because if they're too tight, you might miss out on gains. And if you don't do it at all, like you said, it could roll over any minute and you might start bleeding. Well,
yeah,
yeah.
For sure. So when we look at the long-term trend, I mean, we've been in a bull market really since May of 2025, since this new bull market has taken off. It's had huge gains. If you're looking at it from a bull bear market standpoint, you definitely need a lot of wiggle room. We use price action. We do set initial trailing stop for our long-term investments that trails about 20% under price. And as price starts to move up, it slowly just moves up as kind of like just a default. If there's some black swan event, there is something that will kick us out and protect our money. But overall, as a trader, short-term trader too, you do need to move your stops up, but it depends on the asset class you're trading. So for example, if we're trading the S&P 500, we may have a 5% stop. underneath that, right? And let the market mature. And as we hit certain thresholds, we'll start to move that stop up. But if you're trading a sector that is much more volatile, or if you're trading an individual stock, they all have their own characteristics. So you can use basic analysis. Look at the average true range of how much that asset class moves over a 5-day window, a 20-day window, depending on the time frame style you're trading, and say, okay, well, this thing on average moves 8.5%. So you probably need to put a stop in somewhere around that level. You don't want to put a stop smaller than that asset's average, wiggle room. And so that's how you have to do it. Every asset is a little bit different. In some cases, you need big ones. Other cases, you can use very small ones. So it really comes down to analyzing the asset class or the style of asset you're trading and making sure you have enough room that it can do its thing within an uptrend and not kick you out.
Got it. Is there a particular upside level that you're looking at beyond which you would get out, or are you really just riding momentum right now, and once momentum wanes, then you start to rotate out?
We do have a series of different targets. Like, for example, we got into the QQQ here. We hit a 15% target. Then the market went a little bit higher, and it actually had a little reset from a technical standpoint, and we got back in again. We've come up, we've hit another small target last week, right up near the high here. Now we're letting it mature. So we're constantly kind of legging in, managing the risks, and we have set targets for the Nasdaq and the S&P 500 based on statistical analysis and going back in time. There's certain thresholds that when they're hit, there's a probability, a fairly high probability it could reverse direction. So overall, when we hit those thresholds, we start to trim some profits off and we move our stops up. And so we just kind of rinse and repeat this, and we are controlling our downside risk as the markets go up. Now, when you manage risk, and this is, part that a lot of traders don't like, is when you manage risk, you will generally underperform the stock market. So if the stock market rips higher and has huge gains, because you're scaling out, because you are protecting yourself, you will underperform. Where the strategy that I have, which I call asset revesting, performs exceptionally well, is when there is a market correction that takes months to recover and has a big drop, or potentially years. We don't see our account just, flush down and sell off and crash with it. We actually continue to retain most of our account value. In fact, we can profit and generate returns as the market falls through inverse ETFs or moving to a currency that is rising. So it really comes down to understanding, each asset, how it moves, and setting targets and having reasons, whether it's technical or whatever your other reasons are. I prefer technicals because it's very definitive, versus just like a gut feeling or waiting for news. Something like that, it can usually turn a strategy into a fairly costly one and an emotional one as well.
What would be the trigger for the end of a rally, or this particular rally?
Yeah, the trigger will be more or less when we start to see our bars on our sentiment chart here on the right-hand side, we start to see them turn red. So when we start to see them turning orange and red, like over here, that'll be a sign that, hey, this market has pulled back. It's starting to show signs of weakness. There's distribution selling going on, meaning big money managers are starting to lighten their portfolios. They're selling high volume amounts in big blocks. Once we start to see that, our strategy picks up on it, and the short-term trend has turned down, then our strategy will say, hey, you know what, this trend looks like it's over. Let's get out because it looks like it's going to fall. If it ends up turning back up and stabilizes, we'll have a new trigger and we'll just get back in. So it really does come down to two things. If price action reverses using trend analysis and money flows, we get out. If price just drops very sharply and triggers a protective stop, then it automatically kicks us out and we get out that way. So we have two reasons. Generally, our stops generally don't get hit. Usually the trend changes direction much higher than our stop level is and gets us out at a better price in most cases. But we do have those two ways to get out, either just a hard stop, it didn't work out, something backfired, or news hit, or prices just said, hey, the trend is down, it's time to step aside.
Any particular alternative assets right now? By alternatives, I mean non-stock assets that right now you also really like that you would be long on?
We're not long anything else. I mean, when we look at all the different assets through a hierarchy of like which ones have the money flow, which ones have strong trends, equities is the play right now. And that's why we're in the equities market. The one thing that I'm definitely keeping my eyes on is the dollar. The dollar index, if we zoom out here on the daily chart, the dollar has definitely been forming what could be a very big basing formation. If it starts to break to the upside here, which it actually is pointing to a higher dollar over the next week, that probably means stocks are still going to struggle. We're probably going to see precious metals pull back. But if the dollar starts to break and firmly close above the 100 mark and get up to this 101, I mean, I think that'll be a warning sign that the stock market, I think, is rolling over. I think precious metals will start to sell off, and the dollar could become a very good play. The dollar moves percentage wise fairly slowly, and it's fairly stable. And there's quite a bit of upside potential. There's probably a 5 or 8% potential leg higher that if the stock market and metals start to fall out of favor, you could just move into like UUP, which is an ETF that mimics the US dollar index. And so you could ride that up while everybody else is kind of watching their accounts, slowly dwindle away as the market falls. So this is something I'm keeping my eyes on. We're not in it yet in terms of a play with the dollar, but I'm keeping my eyes on this because it could become one of our plays.
That extension, 8.5%, almost 9% upwards. That's based on interest rates going much higher with the Fed starting to hike rates or something else?
I just drew that as an example. So who knows where that level will be? That's just basing on if the market loses momentum and rolls over. We tend to see money flock. We tend to see the US dollar index do very well. But I'm just showing the bias, like if this breaks out, because what happens here, David, is the longer something trades sideways, the more power it's going to have when it breaks out of that box. And so, the next resistance level will be up here. And so that's where I drew that. But even if it was like a 4 or 5% move, that is a pretty darn good move when the stock market is probably falling 5 or 10% at that same time frame. So it's a defensive play that has upside potential and has very low volatility, meaning you're not going to get hammered with a 5 or 10% move one day like a lot of other assets have.
Okay, this is a particularly interesting trade from Cauchy Prediction Market. How low will the S&P 500 get this year? I think we talked about the highs. Let's talk about the lows. So Traders are placing a 30% chance of 6,300 or below. 25% chance of 6,000 or below. Not particularly very high odds. Naturally, if you look at the S&P 500 projection trade overall, people are more positioned to the upside than the downside. But would you place similar odds? Let's say if you had to make an evaluation, a mental evaluation by yourself, would you place similar odds on the downside below 6,000? And generally, how would you approach this kind of a question, which is where the S&P will go to the downside?
Yeah, so generally the way I would kind of look at a chart would be like, okay, where are some significant lows, significant highs on this chart, and what is the most current type of move? So to me, this looks like, we've had a very big move up here. We had a year-long kind of little bear market and stabilization. So if I was to just focus on this low, saying, okay, this is the next major leg up, I would just use a Fibonacci retracement level. So I'd go from this low and say, based on if the stock market tops out where it is right here, the odds of it pulling back is about 6,000. That's the 38% retracement. That is a very high probability spot where the S&P 500 could pull back to. It could also drop all the way down to about 5,600, which is the midway point of 50% retracement. Those are the two pullback levels that are actually still bullish. When you step back and look at the big picture, those are actually still considered bullish pullbacks, even though percentage wise, I mean, from where we are right now, that's a big drop, right? That's 20 to 26%. But when you step back and you look at a 10-year cycle and trend, that is actually a controlled pullback within a major bull market. When you step back at the super cycle, so there is quite a bit of downside potential where that is. And I think 6,000 is probably a very reasonable level that I think we could see the S&P 500 hit.
Okay, now when we take a look at momentum, and this is something I brought up earlier in the interview, when something goes up, yes, you stay long, but the degree to which it moves up and the speed at which it moves up within a certain time frame, that's important to you as well as a trader. You've talked about this on my show several times before. If you just zoom out over the last 6 months or even 12 months, you can see that the S&P has been in a gradual uptrend. But the last 2.5 months in particular has been particularly fast ever since the stock markets recovered from their sell-off following the Iran war.
Yeah.
When something moves up at a faster pace than usual, do you double down on your longs or do you stay more defensive usually?
Well, we don't double down. We continue to just because I mean, if you double down in a high volatility state, if it blows up, it's going to have a very sharp move, and you're going to get hit twice as hard. So we generally maintain our strategies and continue to play them. We don't get more aggressive with a more volatile market. We just continue to play our strategy, know when to hold stocks, know when not to. And so, when we look at this, I was talking with subscribers about this a while ago. We've got this initial big bounce and move up here. It's about a 28% move to the upside, and very, very quick and powerful. Well, it's the same 28% move that happened right over here. So we're in this same, almost exact same type of move, same type of momentum, same type of like money flows. We're in the same spot. And after that, the market starts to go into this grind, this kind of chop all the way up. And every day it feels like the market is about to roll over, but it inches its way through here. And it's a wall of worry, but the market just keeps grinding its way higher, and it can keep doing this with some corrections along the way for an extended period of time. And that's why you don't want to just like, it looks and feels like the market wants to top right here, but it doesn't mean it's going to. And so I think this market could still potentially inch and grind its way higher, which is why we don't want to get out of it, because we actually have the same setup as what happened after the tariff sell-off. We got the Strait of Hormuz sell-off. So there is a big unwinding event, and money's flowing in here. We got the SpaceX IPO, we got OpenAI, we got Anthropic. I think this is going to stimulate more people to get back into the market, and we could see another leg higher. And if we actually were to just get a gauge of where the S&P 500 potentially could run to, using Fibonacci, we take this significant low, we take this high, we come down to this low. This will tell us where the critical resistance or target levels are for the S&P 500. It is saying we could potentially work our way up to 8,500, which from where that is today, that's another 11, 12%. And I think to add on to what you just said, David, is yes, it's definitely gone very, it's a strong move up. I almost feel like we're about to enter one of these phases right here, this euphoric phase, where we just see this final huge pop and push, and everyone just goes all in on the stock market and on AI and SpaceX and all of this stuff. And what happened? This is what silver and gold did earlier this year. You get that last euphoric phase, everybody goes bananas, and then it has that really sharp correction. And so we could be stepping into one of these where we just see the market really just go absolutely ludicrous here and create a blow off top. And then from there, we could start to see like a lot more damage, and potentially the market starts to unwind. So again, the market trend is up, the long-term, short-term wise. And we just have to see, is this market going to grind its way higher, or maybe is it going to have a parabolic move with these IPOs going to stimulate investors to get back into the market?
Speaking of gold, can you show well, before after you show gold, can you pull up the cycles chart one more time? If gold had its euphoric phase, then logically speaking, it should be in the complacency phase right now, shouldn't it?
It is. Yeah. When we get to that chart, I can show you where gold and silver are pointing to, because it is pointing to lower pricing. So, and of course that bodes, like if the dollar breaks to the upside, I mean, it's going to put a lot of pressure on metals. So
The gold chart. Let's take a look at that. It's been trending sideways for quite some time, consolidating and not going up. And at what point did you look at this and say, look, this consolidating pattern isn't a setup for higher prices. It's actually a setup for lower prices.
well, I mean, believe it or not, and nobody wants to hear this, but it's a setup for both. It is on the long-term chart it's a very big bull flag. If gold finds stability here and starts to run higher, you've got, if you're not in it, you got to get back in it, because the next target is about $8,600 per ounce. The short-term price action, using Fibonacci based on the most recent price action, this sell off and this bounce is pointing to 3,600, which brings it right back into this breakout point, which this is where that euphoric phase was, and price went parabolic. Everybody piled in. The markets are very efficient. Whoever kind of chases and drives price up for a euphoric phase, the market is going to try to shake them out. It's going to try to wait them out, meaning this market could take a year or two before gold and silver maybe stabilize and start to go higher. So the market's very efficient, and it is gunning for 3,600 for gold. So if the stock market starts to roll over, we have seen precious metals sell off with stocks. It's been the norm for most of the year. If the dollar breaks out and rallies as the stock market is falling, that is even more pressure on metals. So we could very easily see gold go into and silver go into a very precipitous sell-off. It's about a 20% haircut, but it'll bring it right back to where it was pre-parabolic spike. And it'll be an amazing opportunity. I mean, if it gets to those levels, I'll actually be looking to get back into physical metals. We sold gold at about 5,100. We sold gold at 111, which was right up at near its peak. And I would love to be able to, accumulate it and reload at a value like that. So what's going on here, David, is this long-term moving average, this green line, the 150-day. A lot of people use the 200-day. It's very similar. The long-term trend is up, but the short-term moving average in trends are down. And the price action is also pointing down. It's actually bearish price action. So we have a long-term supportive trend, but we have two negative short-term trends. And so we have a mixed signal, which is why we're not doing anything in the precious metals space. We just have to let this work itself out. If it starts to break down and sell off, I'm not looking to benefit from a falling price, but I am looking to pick it up when it does hit one of these critical technical levels, which will be a killer deal to pick up metals if it gets down to that price. So that's how I see gold.
Okay. Another prediction market trade. Will Bitcoin outperform gold this year? Low odds, below 30%. What's your take?
Yeah, if we were to look at Bitcoin, man, it's getting beat up pretty bad. It is testing down near a critical support level right over here as of you and I are speaking today at a big sell-off, and some buyers are stepping in. It's in a bear market. The major trend is down. It has a series of bear flags. I mean, I think we're going to see it probably underperform gold. I think gold will hold up much better. I do think Bitcoin has room for a very big drop to the downside. I think we could see 45,000. And depending on how it unfolds, I mean, based on this overall big bear flag leg, it is actually pointing to, which is an extreme level, is pointing to 16,000 again, which was the same type of pattern that we had over here when we had a bear flag and it pointed to 16,000 and everybody was like, it's never going to get there. And of course it did. It took a year. So Bitcoin has got potential to really have a big unwinding event. It has been moving down. There's a lot of selling going on. And I'd be very cautious. I mean, this is the problem, right? Is a lot of people get into stuff and they hold it, and it's created a ton of millionaires. But the problem is after the rally, what happens is they keep holding it because they cling on to bullish bias and people in that space who are always shouting out higher pricing, and they literally watch their wealth and everything just disappear. And so like this is obviously fun. You become extremely rich if you're heavily loaded in it. And this becomes a very depressive and dangerous state because you've just blown up your, everything you just made. And so that's what I focus on as I make sure my portfolios and my followers, we don't go through this cycle. We either step aside after the rally or we find a way to benefit. But Bitcoin to me looks very dangerous, and I think it's got a lot of downside. So I would steer clear of it.
Doesn't it look a lot like the NASDAQ to you, or not so much?
I wouldn't say it does. I think it's really kind of broken apart from what's been going on there. So
Okay.
to me, it looks like it's kind of its own asset class there. And it looks like it's put in a peak and now it's just making a series of lower highs, lower lows.
Whenever you see a divergence, let me just show my screen here.
Sure.
This is my screen. Like you said, it's broken apart. It's trading on its own. Bitcoin historically has moved in line with the NASDAQ, which is why I brought it up. And ever since basically the beginning of the year, first quarter, the NASDAQ has continued to trend higher while Bitcoin has continued to break down. Um, you look at this and you think two things. One is what you said. They've broken apart. Bitcoin is now trading on its own. Or what they call these alligator jaws are set to snap at some point, meaning either Bitcoin goes up or the NASDAQ goes down. And nobody knows which is which. As a trader, how would you evaluate the outcome?
Yeah, well, I mean, I think Bitcoin definitely attracts a lot of people who are going after performance, right? And
Mm-hmm.
so they're usually more aggressive. And what we saw when looking at your charts there, you can see last year back in October, November, it started to really move lower. Precious metals became the shining star. And I think there's money has gone from precious metals a long time ago into the crypto space. And now we very clearly saw last year that precious metals are taking the lead and money's coming out of crypto and moving into precious metals. And then
Mm-hmm.
when we fast forward to where we are today with the NASDAQ, as you just shared, they're diverging in different ways. This is again, I think anybody who has some money in crypto space is seeing the easy money, the massive gains in like Micron, like 1,500% return in a year. Um, that easy money is, I think it's coming. People are saying, I'm done with Bitcoin. Get me out of it. I want to get into something that's moving higher. Everybody's making money in the stock market, and my crypto's killing me. So I think this big leg down is simply people dumping their crypto and saying, get me into the stuff that's working, which is technology, the NASDAQ, and things like that. So Bitcoin's been hit twice. It's been hit with precious metals, took a lot of their buyers away. And then I think the technology space and the stock market is now actually pulling money out of crypto traders as well and saying, I'm selling crypto and I'm moving over to the stock market.
Okay, good. Finally, let's talk about oil. People want to know if gas prices are going to go down anytime soon. And this is obviously a very geopolitical question at its core. We're talking about the war in Iran. But just from a technical perspective, if you were trading oil, what would you look at right now?
I mean, yeah, oil's really choppy. It has been trading sideways for the last couple of months. It's news driven. I wouldn't be trading it. We did play XOP, which is an energy sector ETF a while ago. We played that. We got in, we got out. But overall, it's not something that I'm interested in simply because every morning you wake up and there's a new headline about something working or not working. So I would steer clear of it. I think obviously the longer it stays closed, eventually I think we're going to see oil start to run up and run higher in price just as supply demand issues get more aggressive and more extreme. You can see all the boats, like floating, out there trying to get through. It is absolutely crazy. So I'm worried that gas pricing is going to continue to stay high for a while. And I think oil could really start to run higher, and it could be something that starts to break the stock market. If oil starts to break out and hit some highs and starts heading up to 120, 145, like there's potential for oil to really start to take off. It is probably going to help put a top in the stock market. But technology is defying the gravity. Technology doesn't so much need crude oil, so it's countering the weakness that the energy space has put on things. It's pretty interesting how strong this tech move is and how it counters war and counters strong oil pricing.
My last question I want to bring up to you is Canada. So you and I are both Canadians. We have the last quarter GDP numbers come out. The real GDP was negative, and it's now two consecutive quarters of negative GDP, which technically will constitute a recession. It hasn't officially been declared a recession. Several economists have said in Canada that maybe it's not in a recession yet. The Bank of Canada, I'm reading this article from Reuters today, I think we need to be careful not to put too much weight on any one indicator. The TSX, incidentally, has outperformed the S&P this year so far, year to date, I believe. And when we have a situation where the underlying economy is showing weakness, if you don't want to call it a recession, fine, but it's showing weakness, there's consensus across the board on that particular opinion. Is it only a matter of time before the TSX starts to reflect that, or do you think the Toronto Stock Exchange is merely a reflection of oil, commodities, and other hard assets?
I think the TSX is definitely it's commodity heavy. I think it does what it does in this type of market condition, which is late stages of a major bull market where it's a sector driven market, which technology is doing most of the heavy lifting. It's not a full broad market rally. the TSX generally comes to life and outperforms. We saw it last year for a phase as well, dramatically outperform the S&P 500 and NASDAQ. And it's starting to pick up speed again with the outperforming the S&P 500. So this is normal type of price action. And it is generally an early warning sign. So, I mean, everybody seems to like fudge the numbers, and now they don't want to call it a recession. It's always been called a recession if there's two negative numbers back to back. But again, everybody's changing their language. They don't want to scare people. The financial system and the news is really just pure manipulative and trying to control the narrative. But overall, the markets are still telling us, yes, they're going higher, but there's a lot of risk here. And it's just a matter of time before we have a couple big negative events in the tech space or the data center space or AI that could really turn the markets around and start to shock people. And then maybe it loses that momentum. But the TSX is definitely telling us we should be aware. Commodities are coming to life. And oil is doing most of the heavy lifting, I think, energy for the TSX.
Do you see any indicators of a natural economic slowdown, just based on personal observation living in the country, or is everything fine?
I mean, I live in a pretty small bubble. I mean,
Sure.
Everybody I talk to says everything's just so ridiculously expensive, right? And people are cutting back. There's no doubt about it. But I mean, I don't see things slowing down. Everybody talks about it, but things just keep on going, and people keep on paying for things, and so it hasn't slowed down yet that I see.
Okay. All right. Well, Chris, let's hope the markets don't slow down for our sakes. So where can we follow you to learn more about your strategies?
Yeah, the best spot's to go to my website, thetechnicaltraders.com, or go to my YouTube channel, The Technical Traders. I share analysis on the markets, and really what I do is I manage my own portfolio. I share exactly what I do, my allocations, my ETFs, and I share that with subscribers. We navigate the markets together. The trades I put out are what I put my own money into. So it's not like I'm just dishing out, exciting trades. What I do is actually pretty boring, but it's very consistent, and it protects your capital, protects your lifestyle. That's where I kind of really focus on, is I don't want to have to worry about volatility and worry about falling markets. I just want to continue to grind and watch my account and wealth move up and to the right, no matter what happens in the economy or the stock market.
Okay, good. Well, thanks very much for your time today. Please follow Chris. I'll put a link down below, and we'll speak next time, Chris. Take care for now.
Thanks, David. Take care.
And thanks for watching. Don't forget to like and subscribe, and use my code LYN when you sign up to Couch, the largest prediction market in the United States. When you use my code LYN, you'll get $10 when you trade $10. Link down below or scan the QR code here.